If you feel like you're constantly taking small losses that are bleeding your account out as a trader, this video is going to be for you. There's a good chance you're probably cutting your losses too soon, and in this video I'm going to explain a better way to manage your risk when trading. Now, first and foremost, when it comes to trading, rule number one is still going to be to manage your risk. Obviously, though, there are better ways to do this than others. We don't want to let our losses get out of hand, but we still have to give the trade a chance to actually work in our favor. That means that we don't want to cut every single tiny loss very quickly without allowing the trade a chance to get moving in our favor. So for example, if you were a trader with a $5,000 account and you were buying, say, 500 shares of a $10 stock with a 10-cent stop loss, you're most likely going to get stopped out and take loss after loss after loss with a 10-cent stop loss, because that's just too little for the stock to actually have room to move and work in your favor. A 10-cent move can happen with very normal price action and with very normal and healthy dips in a strong trending stock. So when it comes to managing our risk, the first thing to determine is how much you're actually comfortable risking on any given trade. If you're a new trader and you're trading with a small account balance, this might be $10, $20, $50. And if you are a more experienced trader using a larger account balance, you might be risking $200, $500, even $1,000 on any given trade. But once you have this number in your mind, you can start to use this to determine how you're actually going to trade the stock. So for example, what you should be doing is buying 100 shares of a $10 stock with a stop loss at $9, giving you a $100 maximum loss on that trade. If that was the amount that you were comfortable risking on the trade, that's a better way to go about it than, say, for example, buying 500 shares at $10 with a stop loss at $9.80, even though the maximum loss on that trade is also $100. The difference here is that with the first example, you're giving the trade a lot more room to actually work in your favor, and you're not going to get stopped out by those small, healthy pullbacks, which is probably exactly what would happen if you're using a stop loss that is far too tight. So to give you an example of why it's so important to actually use a wider risk level than you probably are currently using, I want to take a look here at the stock LUCY. Lucy was a stock that was gapping up yesterday in the pre-market session. This was on our radar in the Market Master group for a gap and go. And if we jump over here to the Market Master group, we can see that LUCY was alerted for an opening range breakout at 9:38 in the morning, moving above the opening range breakout level of $1.15. So if I go ahead and actually use this first 5-minute candle here, which gives us our opening range, and I draw the opening range breakout level and then the risk level for this trade, using the opening range breakout strategy, the goal is to risk underneath the low of that first 5-minute candle. And if you were buying into this breakout, we can see that it initially starts to push above that opening range breakout level the very next candle, just going about 1 cent above before coming back down and starting to trade in a pretty choppy range. Now, if you weren't using a proper risk level and you weren't risking underneath the low of this first candle, there's a good chance that you would see this and you would start to kind of get faked out by this price action, maybe sell and cut a loss here around $1.05, $1.10, even though this is still holding above where your risk level should be at on the trade. And we can see that that would have been a very unnecessary loss, because this did end up forming a nice trend here, starting to form these higher lows, and ultimately kind of trended higher and higher throughout most of the morning, before ramping up to a high here of 157, which is almost 40% above the breakout level at $1.15. So in other words, you would have taken a very unnecessary loss here by having your stop loss far too tight, and this would have ended up working out really well in your favor if you had your stop loss in the proper position and you actually gave the trade a chance to work in your favor. Now, this exact same concept should be applied to day trading and swing trading. That example that we just went over with Lucy was a great example of why it's important to use a wider stop loss when it comes to, day trading stocks. But again, this applies to swing trading and longer term trading as well. So for example, if we were to take a look here at the stock NBIS, this is a big momentum growth stock over the past year or so. A lot of people have been trading it and swing trading it for that reason. And we can see that, if we highlight here the range of any given candlestick, we can use this R here in the upper left-hand corner to see what the range is for any given day. And we could see that, on any given day, the range might be $11, it might be $5, it might be $10, $7, Some of the bigger ranges here are closer to $20 or so once we get into these highly volatile moves. We have a range here of $19.44 for this day. So in other words, if you're using a stop loss on this swing trade of say $2 or $3 per share, you're almost guaranteeing yourself to get stopped out on any of these small pullbacks that happen along the way, unless you have a pretty much perfect entry on that trade. And we can see that if we go down to a lower time frame here, this stock has a pullback here on this day from about 260 per share down to a low of about 235, all within the span of about 30 or 40 minutes or so, before recovering all the way back up into the highs by the end of the day, and the very next day pushing all the way up to a high of 290. So if you're using, again, a very small stop loss on this, there's a really good chance that you're going to get stopped out into this pullback that happens here, and then miss out on all of this upside potential that happens throughout the rest of the afternoon and throughout the morning the following day. To summarize, even if you are swing trading or doing longer term trading, it is again important to use these wider risk levels, base your risk level off of some key levels that you're seeing on the chart. For example, using the daily chart here, if you were buying somewhere into this area here, you can maybe risk off of the previous swing low. Same thing if you're buying into this area here, you would be using the low of this dip here for your risk level. And that might be $10 per share, it might be $20 per share. And the idea here is that doesn't necessarily mean that you should be taking a larger dollar amount loss on this trade if it happens to move against you. You would just want to make sure that you are sizing down your positions so that the amount that you're risking on the trade is still a number that you're comfortable with. But this way, you're giving the trade a lot more room to actually work in your favor and to be able to capitalize on the larger trend in the stock. So anyway, that is a little bit about how I prefer to manage my risk as a trader. I try to give all of my trades enough room to actually work, and that just most of the time means that I'm sizing down and trading smaller position sizes than someone that is trying to trade with a very tight stop loss. I hope you found some value in this video, and if you did, please make sure to give it a like and subscribe to the channel. And if you want to learn more about how I trade and get access to our day trade and swing trade bootcamp at Master the Market, as well as all of our day trade and swing trade alerts, our detailed trade plans, our live custom scanner streams, and so on and so forth, all of that is included to all of our members at Master the Market. You can use the link down below in the description to get signed up. Thanks again for watching. I hope you enjoyed, and good luck with your trading.